Good morning, good afternoon, everyone. Thank you for joining us today. Rob's going to present on the SECURE Act. He kind of put this presentation together a few months ago, probably, and we've been kind of talking about it a lot, but we really want to hone in and make sure you guys have a deep understanding of where this is going and what opportunities there are. If you have a question, there's a question box, and we'd appreciate if you would just write it into the box, and I'll make sure that Rob gets to it at the end of the presentation. And without further ado, Rob, take it away.
Thank you, Allie. Good morning, good afternoon, everybody. Today we're going to discuss the SECURE Act. We're going to do a 30,000-foot flyover some of the major provisions in the SECURE Act. We're really going to be focusing on the intergenerational wealth transfer aspects that have been affected with the repeal of the non-spousal stretch-out provisions with regards to IRAs. So we're going to touch base on that. And then we're also going to touch on two other intergenerational wealth transfer ideas or topics. We'll go through the SECURE Act and its impact on the IRAs, and then what are the alternatives to doing the stretch-out IRA. I think a lot of people have already spoken out about it. Ed Slott's already got his piece out about it, which is just, actually he was talking about his solution to the stretch-out. He was talking about it before the SECURE Act was even being proposed. Upstream gifting, which is an intergenerational wealth transfer from the children to the parents, and why would you ever do that? And then it's also a call to action. I want to review what our current estate gift and GST tax limits are and how long do we have left, and really a call to action that I think people have become complacent and think that things aren't going to change for quite some time, and it's just not accurate. And so a call to action to start talking to our affluent clients. And this isn't just ultra high net worth individuals. This is affluent clients and even semi-affluent clients. And we'll get into those topics. So the SECURE Act became law December 20th of 2019. We actually did our first SECURE Act presentation back in the summer when it was a proposed law, and it passed with overwhelming bipartisan support in the House. It passed something like 427 to 3. I don't know what the other 5 people were doing. But, you know, I put on here, no, really. This passed the House and the Senate, and Trump signed it, I think, within 6 or 10 hours of it being passed. He signed it into law. So it really had overwhelming bipartisan support, which is just unheard of in anything that's going on in our politics today. The primary purpose was to revise the U.S. retirement system and improve opportunities for individuals and for businesses to help individuals save for long-term financial security. And it's the biggest change to the retirement system in decades. You know, when I first read it, I viewed it as tweaking around the edges. But if you drill into some of it, there are some decent fundamental changes that should benefit people trying to save for retirement. But, you know, all it did was enhance the defined contribution system that our country has migrated to over the past few decades away from a defined benefit system. So what are the features? One of the key features is that they repeal the max age for IRA contributions. We have clients, I know lots of people that work past age 70 and a half. Well, prior to the SECURE Act, you could not contribute to deductible IRAs if you were 70 and a half or older, and you were required to take minimum distribution starting at 70 and a half. Well, now your RMD start at 72, so we've picked up 18 more months of deferral there. And if you're working and you have earned income and qualify, meet the other requirements of contributing to an IRA, you can continue to fund deductible IRA. So what does that mean? So if you're 75 and you can put $6,500 in, you still got to take your RMD, but your contribution could help offset that and mitigate some of the taxes of the RMD if you're allowed to go ahead and contribute additional funds. It's going to allow small businesses to group together and file one 5500 if everything else with the plan is the same. So you have small companies, you know, 5, 10, 15, 20, 25 employees. Well, setting up a 401k plan is expensive. The flat upfront admin fees are they're not insignificant for small businesses, and they have allowed now that groups of small businesses can come together. So I think what you'll see is associations, whether it might be the AICPA, it might be the FPA, it might be the whatever type of group associations will start setting up group. You can get group term insurance through the AICPA. Well, maybe one day for small accounting firms that don't want to set up their own plans, they'll be able to join a group 401k plan to offer to their employees. And the reporting requirements will be streamlined and shared by all in the group. It does, now I put on here when I wrote this, it allows long-term part-time workers to participate in a 401k. It actually requires the employers to make available to long-term part-time workers. It's required that they make the 401k available to those part-time workers. Prior to this, you could exclude them from the plan. You can make your safe harbor election now 30 days before plan year end instead of 60. And you can opt in after 30 days, but then your safe harbor match must be 4% instead of 3% up to the close of the following year. So they've made it easier. Prior to this, you have to, if you're going to do a safe harbor plan, you have to make that election by November 1st. Now it's December 1st, and you can still do it after December 1st, so long as you make your safe harbor contribution 4% instead of 3%. They're going to offer tax credits for businesses for setting up plans that have auto enrollment built into them. Auto enrollment meaning that when your employee fills out all their documentation with your firm, they're automatically enrolled into the 401k, and there's an automatic portion of their income that's going to go to the 401k unless the employee proactively opts out of the plan. They offer penalty-free distributions in the event of birth or adoption. And now, it used to be you could set up an IRA or even a SEP IRA all the way up until when you filed your tax returns. So if you filed for extensions, you could set up a SEP or a personal IRA all the way up to October 15th. Well, now they've extended for all qualified plans. You can set the plans up until the time you file your tax return for the prior year. They've also, and this is kind of a nod from our perspective, because at Core we distribute insurance and annuity products. So they put in here that they want to have employers offer an annuity and lifetime income options. So you're going to have an option where the employee can make annual contributions to the plan. And then they can turn on a guaranteed income stream coming out of the plan after the assets have been accumulated, or even put in a fixed, say, okay, you could put in you pay in this much every month for so many years, we'll guarantee you this income stream on the back end. So it's kind of letting employees set up a defined benefit plan inside of their defined contribution plan. And they also have removed the fiduciary liability of choosing lifetime income provider. So if I, as an employer, decided I want to use Lincoln Financial as the annuity option inside of our plan, and Lincoln goes belly up halfway through the, 15, 20 years from now, I, as the fiduciary prior to this, could be held liable and financially responsible for the fact that I chose that company when they went bankrupt. That's no longer the case. You have some fiduciary liability protection for which annuity options you choose. They've increased penalties for failure to file plan returns, and they've expanded 529 plans to apprenticeships, homeschooling. Well, actually, the homeschooling provision did not make it into the plan, and you can take up to $10,000 for student loan repayments out of your 529 plan. So there's a whole lot more detailed provisions in the plan. If you would like a piece sent with like the micro details, we would be happy to provide it. So the plan was supposed to be revenue neutral. So how did they pay for it? Bye-bye non-spousal stretch IRA. This is the one provision in the plan that's a takeaway. And this is how they reconcile. They say, well, for non-spousal beneficiaries, and there's a few exceptions for people with disabilities or people with special needs, and basically you've got to take the money out of the plan over 10 years instead of a lifetime. So what does that say? Well, if your 60 and you inherit an IRA, well, you could stretch that thing out over 30 years. Well, now it's only over 10 years. So they've consolidated by 2/3 the amount, the time in which the government's going to get their tax revenue out of those deferred retirement plans at the death of the owner or the owner's spouse. So again, they limit non-spouse IRA distributions to 10 years, no more life expectancy calculations for non-spouses. Spouses can still elect to roll over to their own IRA or maintain it as a decedent beneficial IRA over their life expectancy. Also, dependent children are not subject to the 10-year rule until they reach 18. So if the child's 10 and they're named beneficiary, they'll be able to actually stretch that out over 18 years, because they don't have to do anything till they're 18, and then they have 10 years after they're 18 to take it out. You know, the most tax efficient way to take the distributions out for the beneficiaries is to take the balance and divide it by 10. But it's not required. You can defer it for the full 10 years, and as long as you take all the money out the last day of the 10th year, then you've met the requirements. There is no schedule, there is no stipulated schedule in the code now that says we have to take it out equally over 10 years, or you have to take it out, you know, you still have to take RMD distributions based upon the decedent's age, and then, but no less than depleting it. It's 10 years, so you could inherit an IRA, sit on it for 10 years, and then take a lump sum distribution. Who does this really affect? Well, the poor don't have IRAs. The middle class spend their IRAs in retirement. So it's the top 10% or 1%ers that have IRAs, and it's people who probably don't need the money coming out. They probably are only taking RMD distributions because they have to, not because they want to. And if they could, they'd leave those assets to the future generations. So it has substantially affected multi-generational wealth planning for qualified plans. And so we need to look at alternative strategies. How do you get around it? How do you deal with this? And some of those strategies involve, one, you can start lifetime distributions while you're still alive. Just start spending it down now. So why would you do that? Well, if you're not earning income today, theoretically, and again, this may not, it probably doesn't apply to the very affluent, but you're in a lower income tax bracket in retirement than when you were earning income. I mean, that's the theory. So while you're alive, you start taking distributions, because what happens, you know, you pass away. Typically, when a person passes away, they're in their 80s, and their children, you know, are 20 to 30 years younger. So let's say you pass away at age life expectancy 83, and your kid's 30 years younger than you, your kid's at 30. That kid's 53, probably in or near their prime income earning years. So now they've got to start taking distributions out over 10 years. Now, if they wait 10 years and take it as a lump sum, it's there's a significant tax effect there. If they take it out as equal distributions, it's going to drive them into a higher bracket. So you might be better off while you're alive taking it out. When you're in a lower bracket, take the money, reinvest it someplace else in a non-qualified account, and then when you pass that to your kids, you die, there's a step up in basis, and your kids don't have it doesn't affect their income tax bracket. You can purchase life insurance and leverage the distributions into an income tax-free and possibly estate tax-free benefit to one's children and grandchildren, and you can spread it out over multiple generations. That one we're going to drill in quite a bit, because, you know, bottom line is that is one of the most efficient ways to recreate and actually make better than what a traditional stretch IRA would look like. So the other option is keep it in the estate if you don't have an estate tax problem, and you can leverage it both into life benefits and income tax-free long-term care benefits. One of our product partners, One America, has a qualified plan strategy where the client can transfer a portion of their IRA. So let's say they have $500,000 in an IRA. We could take 100,000 of that, transfer it to One America. They have a product where they're going to pay a 20% bonus on that deposit. So that's going to mitigate some of the taxes of the distributions out of the IRA. So they're going to spread that out over 10 years. They're going to take the 100,000, take 10,000 a year. So you're going to have 120,000. They'll take out 12,000 a year. 2,000 goes to paying taxes, and 12,000 then goes into funding a asset-based long-term care solution which will provide income tax-free leveraged long-term care pool. So that's one strategy. But for really set up a long-term multi-generational stretch-out strategy, we propose that you put it into an ILIT that's also a multi-generational dynasty trust. Dynasty trust is the brand name, generation skipping trust is the generic name, and distributing income, but not necessarily principal, to future generations, thus avoiding all future transfer taxes. So we know what current law is, and we're going to delve into that. But who knows over the next 20, 30, 40 years what transfer taxes are going to look like. So we're saying take the IRA. Let's figure out let's spend it down over 10 years, 15 years, or 20 years. Which one is most efficient really is going to depend on each client's circumstances. Take the net after tax dollars. Use it to fund life insurance premiums into an irrevocable life insurance trust and buy life insurance. Why life insurance? Well, if you just put the investments inside of the trust, it's going to be taxed at the trust tax rate. Now, you could make the trust effective and have the income tax consequences flow back to the grantor. But life insurance is going to, one, there'll be no tax consequences inside of the ILIT, and the leverage of the premium payments, the internal rate of return of that death benefit for the premium dollars contributed, you're going to end up with a net amount that's going to be greater than what the IRA would have been if the kids had inherited. And the difference is, so the life insurance pays income tax-free to the trust. So now the trust can be set up just through the provisions of the trust. You can set it up so that it doesn't distribute corpus to the children, except under special circumstances, health, wealth, maintenance, health, welfare, maintenance, education type things you put provisions in, and it only distributes income. So you could stretch that pool of money out to that over the remaining lifetime. And then when that first generation passes, you can have it pass to the grandchildren, and you can have it go to the great-grandchildren. And, in each step along the way, you can use some of the assets in the trust to buy life insurance on each subsequent generation, which keeps replenishing the trust. So it gets the qualified funds out of the estate, so you're not facing income with respect to the decedent to the heirs on those distributions. You can now go from a 10-page force-out distribution of the assets to multi-generational. It's very tax efficient. The internal rates of return on the life insurance are very strong. And again, we don't ask you to take our word for it. We'll show the math, show the numbers, show the internal rates of return of what we're talking about. So it's an alternative. You could also arrange for the death benefit to just drop into a single premium immediate annuity for your heirs, where you take the death benefit and it pays out a lifetime stream or a lifetime with period certain or life with installment refund, however you want to structure it, where you provide a guaranteed income for life for the heirs going forward. There's a lot of additional strategies to mitigate the loss of the stretch out and qualified plans. The one thing I will say, I have run analysis. I have sat down at the computer and run various analysis, various scenarios about net worth, tax brackets, rates of return, age of the beneficiaries, age of the parents. There is no one surefire solution from a pure mathematic perspective. It really depends on, are they subject to estate tax or not estate tax? Do they need the money? Don't they need the money? Do they need some of the money? What's the tax bracket for the children? What's the parents' tax bracket? We run a comprehensive analysis. So from a pure IRR perspective, there's no one size fits all. There's no universal blanket statement we can say this is what everybody should do if they don't really need the income off of their IRA. So we help provide that analysis. But let's forget just the analytics. Let's look at the intangible aspects of the planning. If you leave an IRA directly to an heir, they can take a lump sum anytime between year day 1 and end of year 10. If you have children that you have concerns about their financial how financially responsible they are, and you want to put some kind of brakes or levels to stop them from taking a lump sum and buying a fancy sports car, traveling around the world for 1 year, and then they're broke, you can do that through alternative planning. So yeah, we got to look at the math. Doesn't make economic sense. But we also need to look at, and you can also set it up so that the assets that are coming out of the IRA are put into a trust that provide asset protection, provide liability protection, provide protection of those assets against future divorce. Who knows what the future holds with all of those aspects. So you can provide a lot of other protections involved that really, if you just name a beneficiary in the IRA and they get to take it out over 10 years, there's not a whole lot of protection breaks or any type of governing events there. It's have at it, and everyone else around that person have at it. So we need to evaluate those, and that's really get to know your client. What is it that they want to have happen? Some other aspects of this planning, I will tell you, it is absolutely critical that you review with every client. Ask them, when's the last time you reviewed the beneficiaries on your qualified plans? Why do I say that? If there is not a named beneficiary on the plan, it's a 5-year distribution. Period. It doesn't matter. So, no named beneficiary, or you name the IRA owner's estate beneficiary, it's a 5-year distribution. The only way you get the 10-year distribution is if they are named people. And again, if you name or don't have a beneficiary, your spouse doesn't get to roll it over. I mean, they weren't named beneficiary. So very important, and use the timing of this act to ask all their clients, let's review your beneficiary designations. It's absolutely critical you do it. And if they have a trust named as beneficiary, most of the estate planning trusts that I've seen that deal with the stretch out IRA were set up as conduit trusts, which means they distribute all of the income as it comes through the trust. So you have the IRA, it maintains its tax deferral as a decedent IRA inside of the trust. It makes its minimum distributions, and the trust just distributes those to the beneficiaries. Well, now, if you do that, that means you're subject to the same 10-year rule as far as distributions getting from the IRA to the trust to the beneficiaries. You might want to see about revising the trust, that the trust can actually hold assets. If you want to govern, though the assets will be now taxable inside of the trust, it can distribute less than the RMDs or the distributions coming out of that IRA. So again, we need to look and review whether they're conduit trusts or they're trusts that have the ability to retain assets and then distribute income based upon the terms of the trust. So really, there's a lot of opportunity to have conversations with clients about this. If clients care, Ed Slott's already got a presentation, and his whole thing is life insurance is the better solution. And I will say, he was saying that before the Secure Act happened. He used to say, look, you need to take the distributions out if you don't need the income, and you need to buy life insurance outside of the estate. He was banging away at that for years. So now he's just restating it in the context of the changes that took place. He said it's a better solution than what a traditional stretch out was. So I also want to talk about another intergenerational planning strategy. It's pretty interesting. It's called upstream gifting. Many children provide financial support for their parents and grandparents. They supplement their parents' lifestyle by paying for vacations, entertainment, improved housing, cars, etc. Many pay for basic needs like everyday living expenses, medical expenses, assisted living facilities, or adding on to their home and having their parents live with them. They're providing substantial financial support. So there's something called upstream gifting. It's a type of wealth transfer planning. Upstream gifting involves the transfer of assets to senior generations. The children gift appreciated assets to their parents. Now, when you do that, the children's cost basis is going to transfer over to, the cost basis remains what the kid's cost basis is when it would transfer to the parents. But upon mom and dad's passing, the assets are returned to the initial owner, the child that gifted them the assets. While the parents are alive, they use the income coming off of those assets to pay for their living expenses, which the kids were already paying for. So that's a net, no more, no less out of the kid's pocket. But when mom and dad pass away and those assets are returned to the initial owner, there's a step up in basis. Mom and dad, we're assuming they don't have an estate tax problem. If they had an estate tax problem, they wouldn't need the kids giving them assets. So it's kind of part of the solution. So when mom or dad dies, names the kids beneficiary of those assets. There's a step up in basis. Kids get the asset back. They now, if they go to sell that asset, could have no or substantially reduced capital gains taxes with regards to the asset. So I'm going to use an example. The kids own a $2 million of commercial real estate with a $200,000 cost basis. Kids gift property to mom with $200,000 cost basis carryover. Mom uses the income from the properties to pay her living expenses. At mom's death, she leaves the property to the kids. Cost basis steps up to the fair market value at her death. No estate tax due as mom's estate is below $11.4 million. It's below any threshold that we've had in the last 15 years. And then the kids to sell the property soon after and avoid capital gains. So it just helps minimize the capital gains treatment when the asset comes back to the kids. Gives them greater flexibility. Some people hesitate to sell properties because of the capital gains treatment. Has a substantial impact on the returns that they've earned on that property. So what are some things to consider? With ownership comes legal right to sell the property, give it away, or leave it to someone other than the gifting children. So son gives property to mom. Mom was single at the time. Mom decides that, her personal trainer to Jim is a really cute guy. Mary's cute trainer to Jim. Well, mom can leave that property to cute trainer to Jim when she passes. Nothing you can do about it. Or gift it to the other children and say, well, Bill, you've got so much, I'm just going to give this to your brother, not you. So assets gifted to the parents are also subject to their liabilities. I told a story on my last presentation. So my daughter was driving home from school. She was following one of her friends. They were coming down the road from school, headed home. And this 75-year-old lady just came shooting out of a parking lot at a shopping center at top speed across 4 lanes of traffic and hit her friend's car who was right in front of her. And my daughter said, 5 seconds later, that would have been me. The car went spinning, tore off the front end, cars just damage everywhere. We have a snowbird migration here in Arizona, and some of the things I have seen since the holidays have ended, just last week I'm driving home, 2-lane road headed to my house. There's a gentleman in his big old Mercedes over in the right-hand lane, and he just goes completely horizontal in the lane, blocking all of the lanes of traffic, just sitting there. Because he decided he was going to make a left turn from the right lane and then decided, well, maybe he's not sure he wanted to make that left turn. And he sat there contemplating the question for quite some time, holding up traffic. And he was just completely unexpected. So when I talk about the liability of your parents, it's a real liability and something to be considered. There's legal action, and there's also, mom likes the personal trainer, mom marries personal trainer, mom figures out, well, that wasn't really smart, divorces personal trainer. You want to prevent that property being part of those proceedings. A lot of this can be addressed by using a trust. It is necessary to make sure that the language in the trust is done properly, so that it allows for a step up in basis. The other part of this is that the trust or your parents need to hold the property for at least a year for there to get the step up in basis. If mom's on her deathbed and you go in and do this transfer and she dies 4 months later, the IRS is going to disallow the transaction. They're not going to allow for the step up. Mom or whoever you gift the property to has got to survive at least 12 months from the transaction date for you to get the step up in basis when the property reverts back to you. So it can't really be done on a short-term basis strictly to be avoiding capital gains tax. But if you set it up in a trust can provide creditor protection, and the kids can set the trust up for mom, say sign here, and they name themselves beneficiaries and make sure the assets come back to them. Again, this really isn't an estate tax play. This is mitigating capital gains play. So another advisor pointed out to me, he says, well, let's say you set it up and the transaction goes down, you claim the step up in basis and the IRS goes to challenge it and you lose. What harm have you done? You're right back to where you would have been had you not done the transaction. It was an interesting perspective. So we have a huge opportunity. We have now an $11.2 million per person exemption, $22.4 million per married couple. It's the largest opportunity probably anyone on this phone call has been alive. I'm forgetting about 2010 when everything went away for 12 months. But for estate tax, and then there's an estate tax due of 40% on any amount above this threshold. I think it's very important that people understand that this expires on December 31st of 2025. The reason that have sunset provisions is because if the Congress is going to pass something and they can't make it revenue neutral, they have to put sunset provisions or a finite time frame on the act. So they did that with this one. But really, I don't know if we have till 2025. If anyone's paying attention to what's going on in the presidential election cycle, pretty much every one of the Democratic candidates has said day one they're going to repeal the Jobs and Tax Act of 2017. If you look at what their substitute provisions are, and we'll go over some of their positions. So this act is only as good or has as much life in it as the next Congress that might overturn it and repeal it or impose something more draconian. So I think that, you know, between now and we have an election in November, and then we probably got a few months of a lame duck Congress, we ought to be telling our affluent clients they need to be looking at this. Now, and it doesn't mean just the people who have estates over 22.4 million. So if nothing else is done, the estate tax now reverts to 5.5 million with an $11.2 million limit. We're going to talk about the country's fiscal situation to allow people to try and assess from a probability perspective is what's the probability that the current regime is going to be extended into 2026. So there's a potential for significant wealth transfer planning today. I think people should take advantage of it because we don't know what the future is going to hold. If it's the type of planning that people think they should be looking at, you need to talk to your clients about it because, you know, this is what's happening in our current fiscal situation. We currently have a aggregate debt of $22.5 trillion. It's the fourth highest debt to GDP ratio in the G20 after Japan, Italy, and Singapore. Art Laffer says that comparing debt to GDP is like comparing a P&L item to a balance sheet item. He says it really doesn't make sense, but that's how they've been measuring it. So the last tax act is estimated to add between $1.9 and $2.3 trillion to the national debt above the already projected $9.8 trillion cooked into the books. So over the next 10 years, we're looking at an additional $11 trillion of debt. The 2019 deficit, it actually came in at just under a million. It was slightly lower than, $1.085 billion. I'm sorry, $1.085 billion. And it was double the deficit in 2018 to $526 billion. I remember when the Tea Party went to Congress, they were all frothing at the mouth because we were running $300 billion deficits. I don't know where they went with the Tea Party. But it's, we're projected to run $1 trillion deficits over the next 10 years. And it's also estimated over the next 75 years, the unfunded liability for Social Security exceeds $13 trillion, and the unfunded liability for Medicare, Medicaid is $37 trillion. So what does that mean? Why do I bring this up? Well, if Trump wins, we have, we'll make it probably, well, at least to 2024, the end of his second term. And maybe we make it to 2025, the December 31st date. If Joe Biden wins, he immediately wants to repeal the tax cut. Now, they keep saying it's a day one issue. It really requires an act of Congress. You can't do it with an executive order. He wants a top bracket to go back to 39.6%. He wants to eliminate the step up in basis at death. Well, there goes my strategy number 2 today. And then he wants to double capital gains. He basically wants capital gains treatment. He wants to treat as ordinary income if you're making over $1 million a year. Elizabeth Warren, she wants a wealth tax, 2% for 50 million, 3% for $1 billion, 40% exit tax if you want to renounce your citizenship. She wants to go back to a $3.5 million state exemption with a 45% estate tax. She also wants a progressive estate tax, which as the, the more your net worth is, the higher it is. And I believe her top estate rate, her plan tops out like at 74%. She's all for free college, free health care. She also wants to impose a financial transaction tax so that every time the rich people go and invest their money, and I'm being a little facetious, it's when anybody goes and invests money, they're going to pay a tax on every one of those transactions. And then we got dear old Bernie. And again, I'm trying not to make any political commentary, but this is what their positions are. He wants free health care, free college. He wants immediate repeal of the 2017. He wants a progressive estate tax of 55% up to $1 billion and 77% over $1 billion. He wants financial transaction taxes. He wants to raise the payroll threshold to $250,000. No capital gains treatment whatsoever. Everything's ordinary income. And when the field first started and they had to run 2 debates over 2 nights and get big stages, these were some of the moderate tax proposals that were on the table. So we're looking at all this. So I remember everyone said, Bernie Sanders it's never going to happen. Yeah, they said that about Trump. Never going to happen. It happened. I don't think we should take for granted what will or won't happen. So what are the odds? So this is my cute little comment. I haven't a clue. I dropped my teacup in the wishing well, and I haven't seen the future since. What I do know is what the law is now, at least through January of 2021. I believe we have an opportunity to instill a sense of urgency for people to start planning now. You may not have $22 million estate, but what about $3.5 million? And even if you don't have $3.5 million, what if you have retirement funds that you would like to benefit your family for generations to come? Life insurance is a powerful tool to use leverage, tax favored treatment, and private beneficial transactions to achieve your desired outcomes. As far as the timing of the planning, yesterday is better than today, and today is better than tomorrow. Again, I just don't think we have all the time that people think we have for dealing with these wealth transfer issues. So what does it mean for the future? What does all this mean for the prospect of future taxes? I don't know. But if you were betting your family's future, which way would you hedge? Which way would you plan towards? It's important, again, to note that the Tax and Jobs Act expires 12/31 of 2025, and we may lose it sooner than that. So that's our presentation. What I would like to say is that we are very adept at providing expert analysis, reviewing each client's circumstances. As I said, there is no one-size-fits-all solution for any of this. It requires good discovery, finding out what's important, who's important, what's important to your client, what their vision, values, and goals for their wealth and their future is, and for their children and their grandchildren. That combined with the analytic numbers of what they have, rates of return, tax rates, income needs, and we can run a comprehensive analysis and provide comprehensive solutions to help your clients achieve their outcomes for their reasons. That's my presentation. If anybody has any questions, be happy to take questions.
I'm not seeing any in the chat box, so I think we're pretty good.
Well, I appreciate everybody taking the time today to visit with us. We've got some other workshops coming up. We've got a workshop coming up with regards to the Secure Act and how you can implement that and convert some of the benefits into long-term care planning strategies. It's also going to talk about some of the provisions of the Pension Protection Act of 2006 and being able to take substantial gains in annuities and turn them into income tax-free long-term care benefits. Allie, what other workshops do we have coming up?
Yeah, we're doing, so that'll be with Brad Shepard, and then we have Strategies for Volatile Markets coming up on the 19th. That's going to be at 3 p.m. Eastern Standard. So, and then the one with using qualified money for LTC and Secure Act provisions related to inherited IRAs will be on March 5th at 1 p.m. Eastern Standard Time.
It seems there's a little volatility in the markets right now.
Do you think? Oh, get ready for the call.
All right. Well, thank you, everybody, for participating. Hope it was worth your time, and we'll talk to you soon. Thank you.
Thanks, Rob. Bye-bye.